the scenario of an agreement between the government and the Republican opposition was by far the center scenario. Therefore, I would not be expecting a major relief rally. Most part of these good news were already in the prices. To be honest, it is possible that the market in the next few days will focus on the execution risk. The fact that this agreement needs to be sealed down with the proper laws, and needs to find the votes, especially at the House, and this might trigger the attention of the markets for the next couple of days.
What about the ramifications on interest rate policy? There's a view out there that now that this worst case scenario is averted, we can go back to data watching. And the recent data that's come out in the U.S. has actually surprised to the upside on the spending numbers, on retail sales, even on the revised GDP print for the first quarter.
Yeah, this is definitely true. The U.S. economy keeps on proving to be very resilient to the tightening that the Fed has instigated in the last year and a half. Numbers keep on being strong. Inflation is less polite than what the market thought and expected, and the possibility of a rate hike between June and July is definitely there. On the top of this, on rates, we need also to remember that now, assuming that, of course, there is an agreement sealed on the debt ceiling, the Treasury needs to replenish its general account. At the end of last year, the Treasury had this kind of pocket of liquidity worth roughly $700 billion. Now it's gone close to zero. This has to be replenished in the next, let's say, for the remainder of the year, and this will add pressure on the fixed income market and possibly on rates.
Well, Antonio, on the flip side, while yes, U.S. data has been more resilient than expected, the world economy is showing signs of slowing down. You've got the COVID recovery in China fading. The data out of Germany in particular has been pretty discouraging lately. The ZEW survey, PMIs last week showing a massive drop in new orders. And we are seeing signs of some cracks, some cooling anyway, in the labor market in the U.S. And yet, U.S. markets hit 9-month highs on Friday, equity markets. Do you think there is a degree of complacency when it comes to the economic outlook?
I think that the tightening financial conditions will hurt the economy. This time is not different. Therefore, making credit more expensive and less available will trickle down in the real economy. We need to keep also in mind, however, that we are coming from 2 years of unprecedented stimulus, monetary and fiscal, and therefore the reaction time to this tightening, it takes longer. In terms of markets, we need to look at the dispersion of the performances, especially U.S. market. The S&P is lifted by a bunch of names, the usual suspects of the digital economy, plus the semiconductors who joined the bandwagon only in the last few days. And all these things together are probably providing a picture of the market that is not really representative of the whole market. Outside those names, prices year to date are definitely lower, performance are definitely lower. The equal weighted S&P is basically flat on the year, while the main index is up almost 10%. So there is a level of complacency that is hidden below the surface of the major index.